If you are a dividend investor, chances are you've made at least one of these mistakes. I know I have. In today's video, I'm going to cover the top 5 most common mistakes made by dividend investors that can crush your returns and most likely crush your future passive income goals. Whether you're just getting started or you've actually been at it investing in your portfolio for years, this video will help you avoid those costly slip-ups that could seriously slow down your path to financial freedom.
Come with me if you want to live.
And you're going to want to stick around to the end because mistake number 5 is something that I still see people do even with 6-figure portfolios. And the thing is, it's completely avoidable, super easy to avoid. So mistake number 1 is chasing a high dividend yield. And we've all been there. If you've been investing for quite some time, I'm sure you've probably been there too, because I can remember when I was there. You see a 9 or 10% dividend yield and you think to yourself, wow, I just hit a jackpot with this stock.
Holy Jesus. What is that?
But the truth is, man, in most cases, high yield equals really high risk. These companies that have these sky high yields, for the most part, they're doing it to just attract investors while their fundamentals are completely deteriorating. And to be honest with you, a lot of times these dividends are not even sustainable. The dividends usually get cut. And when that happens, the worst part about it is not only do you lose your consistent monthly income, but you also lose the money you put in the stock because the stock price will tank. So instead of chasing that really high dividend yield, look for something that has a really healthy payout ratio and for something that has a pretty good track history of paying out dividends and growing their dividends over time. A great example of this would be a stock like Home Depot. If you invest in a stock like Home Depot, you're probably in really good hands. Home Depot is currently trading at about $371 and their dividend yield is 2.48%. And they've been consistently paying that dividend for 35 years and they've been growing it for about 15 years as well. This is one of those stocks that you can sleep pretty well at night with. And this is a perfect time for me to show you something because one of the reasons why I like to create this content is to show you what is pretty good to do and what is not so good to do. I had one of my viewers leave me a comment on one of my videos that I recently created. And he left me a comment saying, I'm doing $100 a month in dividends with $1,600. Okay, that's already red flag number 1, okay? In ticker symbol ULTY. He says 30K is the old school way of using growth stocks. Wow. Okay, Asensio, this is not to make you feel bad. This is just to use it as an example for everybody to learn from, okay? So as you can see, I replied to him and I try to keep this as nice as possible. I basically said, I wouldn't go that far to saying that it's the old school way of investing. ULTY has horrendous, and I mean, I'll show you the chart now in a second. Horrendous NAV depreciation. This thing has been eroding from the time that it was listed in the market. And I told him straight up, I said, man, I probably wouldn't touch that thing with a 10-foot pole. I wouldn't, if you gave me money, I would not put that money in this. And if I was in his shoes, I would look for something a little more like JEPI or Triple QI. That's as risky as it gets. I mean, how much more risk do you want? You're getting an 8 to 9% yield on one of them and you're getting about a 14% yield on the other one. So I say that to tell you this. Be careful with chasing these high yields on these companies that you can make $100 a month with $1,600, $2,000. Because what happens is eventually that dividend is not sustainable. It's going to get cut. It's only a matter of time. And when it gets cut, not only are you losing that monthly income, but you're also going to tank the stock price even more.
Come on now, dog. Come on, man.
So what I like to do is I want to invest in a company, even though it does take a lot longer, it is a lot safer. I want to invest in a company that's going to pay me a good dividend. It's going to increase the price of that dividend every year. So I get a pay raise for doing nothing. And the dividend is something that I can count on. I could go to sleep at night and I don't have to worry about it being cut. And not only do I not have to worry about that dividend being cut, but I don't have to worry about the stock price tanking. I know that the money that I put in this stock that I worked hard for is going to be safe. I want to sell the stock 10 years down the road and the money that I put in, I'm going to get out and then some. That is the goal of dividend investing. If you didn't know, take some notes. Now you know. And that brings us to mistake number 2, not diversifying your portfolio enough. Dividend investors, we love what we know, but putting your money all into one sector like utilities, REITs, or financials can backfire really fast. So for example, if interest rates rise, REITs and utilities often take a pretty good hit. And if you are not diversified, your entire portfolio can suffer, which then can trigger the emotional trading of you wanting to dump your shares and be at a real loss, a realized loss. We don't want to go there. To avoid this from happening, you want to make sure that you're spreading your money across different sectors and different industries. Something as simple as investing in an ETF like SCHD, VYM, and the Triple Q. These 3 alone can help you diversify your portfolio. Now, moving on to mistake number 3, and I will be honest with you, this one often goes under the radar and you make this mistake without even knowing. ignoring dividend growth. And the thing is, I feel like if you're a new investor, you're more susceptible to have this happen to you, ignoring the dividend growth. I know when I first started, this happened to me a couple of times. I put money into a stock, I was investing in it for a couple of months, and then I looked, I was like, holy smokes, this thing hasn't raised their dividend in 3 years. What am I doing investing in this? And again, it comes along with the territory of being new at investing. Building a dividend portfolio for the first time, I had done this thing for like 5 or 6 weeks. I read a couple articles, I looked at a couple YouTube videos. I really had no idea what I was looking at. And like a lot of new investors, you only focus on what the company's paying today, but you're not focusing on what the company's gonna pay you in the future, which is really what's important. Dividend growth is what actually fuels that snowball effect that we've mentioned in my other videos. A stock that is growing their dividend by 7 to 10% every single year can double your income in less than a decade without you ever having to purchase another stock of that company again. A great example of something like this is a company like Costco. Even though they don't pay a lot in dividends, they grow their dividends significantly. In the last year, you can see here, they grew it 12.44%. And in the last 5 years, they have an average growth rate of 10.51%. Not only did those shares go up in value over the last 5 years, significantly to say the least, significantly, but they also gave you a pay raise every single year in dividend income. Although it does take a lot to build a nice source of income with Costco because their dividend yield is about a 0.5 right now, 0.53 to be exact. It is nice to know that year over year, you're getting a pay raise from that for doing absolutely nothing. And yeah, the dividends might not be that strong, but you are appreciating a good amount in the stock. And as you can see in this chart right here, Costco is up over 200% in the last 5 years. I'd rather invest in this than anything like a ULTY. Any day of the week, I'll put my money blindly into Costco before I touch one of those other companies. It's just simple numbers. 5 years ago, you would have invested $10,000 in Costco. Today, you'd have well over 30 grand. Moving on from that, mistake number 4, believe it or not reinvesting your dividends. And I know this is tough for some of you seasoned people to understand.
What?
How? Hold on, bro. How?
There are new investors out there that do not reinvest their dividends. I got a buddy of mine, Vic, my Dominican boy. Stop going to Bávaro Beach. Stop going to Punta Cana with your dividends. Reinvest those dividends so we can grow your portfolio, please. Listen to me. You'll thank me later, okay? If you're early on in your journey, one of the biggest mistakes you can make is not reinvesting your dividends. This is going to hurt you in the long term with the compound interest side of things. That money that you're taking out of your buying power, or you're just letting it sit there in cash and do nothing for months on end, that money could be compounding for you, buying you more shares, which would mean bigger dividend payments in the future. Reinvest your dividends. Whether you reinvest them manually on your own, you open up your portfolio, you look at the best deal in the market, and then you put that money into those stocks. You don't have to reinvest it into the same stock. Or you put it on a drip and you let it reinvest back into the same stock. I would rather do that than let it just sit there not doing anything for you. But by reinvesting it either manually or through a drip, it will turn your portfolio into a dividend printing machine. And reinvesting your dividends is one of the easiest ways to let compound interest work for you. Let that snowball just roll down the mountain and do all the heavy work for you. So to wrap it up, I'm going to give you mistake number 5. And I know this one's pretty tough because I sometimes have to check myself, right? I'm like a little dog out of pull that leash on myself sometimes and put myself in check because I tend to want to do it as well. Mistake number 5, timing the market. And let's be real, man. Nobody knows how to time the market. Nobody can tell you that they know how to time the market. If somebody tries to sell you a course or somebody tries to put you in a Discord chat or something and they tell you, I know how to time the market, run for your life. They're lying to you. Nobody knows how to time the market. If they did, they'd time it perfectly. Well, I take that back because Nancy Pelosi probably knows how to time the market better than anybody, but we won't go into that in this video. But anyway, unless you know Nancy Pelosi, do not time the market. So I say that to say this, trying to time the market is one of the biggest traps you can get yourself into. You might try to time the market and then you think, oh, I'm going to let it drop a little bit more to get in, right? I have $15,000 or I have $5,000, whatever it might be. I'm going to let it drop a little bit more and then I'm going to get in. Chances are, historically speaking, that never works out. The stock starts to climb. It hit the bottom. You didn't know it hit bottom. It starts to climb on you and it's just up and up and up and up from there on out, building all-time high to all-time high to all-time high. And you miss your point. And now you're buying something for 14, 15, 16% higher than what you could have done a month ago because you try to time the market. Waiting for the perfect price or pulling your money out of the market because of the market noise will destroy the long-term growth of your portfolio. The most successful investors to have ever lived, guys like Charlie Munger and Warren Buffett, these are guys that stay consistent. They consistently put money into their portfolio. They stay invested through all times of the market and they reinvest their dividends time over time. You have to let compound interest do the heavy lifting for you here. That is why they call it the 8th wonder of the world. And let's just be real with each other, man. You or me, we're probably never going to catch the exact dollar bottom of a market correction or a market crash, but you will catch those dividends along the way if you just invest in it consistently in your dollar cost average like you're supposed to do. And that's really what's going to build you wealth over time. I know it's not the sexiest thing, but it's just the truth and it's what works. So here's a quick recap. Take a picture of this with your phone, take a mental note, write it down, do what you want, but please remember this. Number 1, do not chase yield. Number 2, diversify your portfolio. Number 3, prioritize dividend growth. Number 4, reinvest your dividends. And number 5, please stay consistent, not reactive to the market noise. Just stay consistent and you will thank me later. And I promise you, if you can avoid these 5 mistakes, you will be miles ahead of the average investor. And over time, your portfolio will thank you in cash. And if you got some value out of this video, smash the like button and subscribe to the channel if you're serious about building passive income through dividend investing. And go ahead and let me know down in the comments below, what is a mistake that you have learned from personally? I know I've learned from a couple myself throughout the years. So with that being said, I want to thank you for watching. I will catch you on the next one. Peace.